Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video, I'm going to cover off a pretty big concern that virtually everyone has when it comes to the retirement income plan. Now, this concern for many people is at a subconscious level, but every once in a while it breaks the surface to be a very conscious concern that people want to make sure they're dealing with in the retirement income plan. And we're going to cover off the concern, and then we're going to cover off 7 strategies for dealing with the concern, and these are strategies that we've covered off in various videos over the years. So I think you'll enjoy the video. Now, if you're new to our channel, make sure you hit subscribe so you don't miss future content that we're posting on a regular basis. If you're looking to get some confirmation that you're tracking in the right direction for retirement, visit our webpage. There's a link to our website where you can find out how you can get a complimentary retirement forecast. And as well in the show notes, you'll find links to helpful retirement planning resources. Okay, what's that big concern that people wrestle with? Of course, the big concern is, I don't want to run out of money. I don't want to have more life and income. So how do I make sure that I plan my retirement so that doesn't happen? So let's cover that off. Okay, let's cover off those 7 strategies. How do we make sure that we have the confidence that we're not going to run out of money through our retirement? So the first strategy is a really straightforward one. It's not going to be news to you, and that's budget planning. So before you retire, you need to be very, very clear on what your expense requirements are. You need to track expenses for a period of time, get clear on those expenses, forecast what your periodic expenses might be, as well as expenses that may come up once you're retired. Are you going to be upgrading the vehicle? Do you have some renovations for the home? What kind of traveling are you going to do? Get really, really detailed around those numbers. So what happens often is people are not precise in this area. They start spending money from their portfolio, and before they know it, they're in trouble in terms of how much money they've spent and what is the sustainable spend in their budget planning. So the very first thing you do, no matter what strategies you put in place, is be very clear in your budget and stick to your budget. Make sure you're tracking expenses. Now, part of that is making sure that you do regular cash flow reviews. So again, your retirement plan is sort of like, you're steering the ship across the ocean, or you're flying a jet across the ocean. You've got a destination point, and you know that there's constant course corrections that you're doing to make sure you get to where you want to get to. You can't be cavalier. You can't, review it just before you get to your destination point, because you may be way off base. So part of retirement planning and making sure you don't run out of money is making sure you're reviewing your budget, making sure you're reviewing your assumptions, and making sure that you're course correcting along the way so you don't run into trouble. Now, the other thing is you need to define what your non-discretionary and discretionary expenses are going to be. So that's spending allocation between those things that will always be there. And so those are the basic expenses, and there are strategies for making sure you have guaranteed income sources matched against those non-discretionary expenditures. So that's really critical as part of your retirement income planning. And then dial in what your discretionary expenses or spending might be. So that might be for travel, entertainment, hobbies, that kind of thing. Why is that important? Well, if there's periods where you have some non-discretionary expenses that might be higher than normal, then you dial down your discretionary expenses so you continue with your matched budget. So discretionary spending is something you would like to do, but you don't have to do. And it gives you a bit of a safety valve if you have to make adjustments or course correct along the way. So again, these ideas are talked about in the course that I mentioned. Again, you can go to the show notes to get that information. So these first 3 are really, really critical. If you follow these ones, then you'll be well on your way to making sure you don't run out of money in your retirement. Now, the next area, which is just a generalized idea around how to handle your portfolio, it's called the 4% rule. Sometimes it's referred to as the 3% rule, but essentially, here's what the rule is. Take your investment portfolio that you're going to use to draw income from to supplement government benefits or employer-sponsored pension plans. The basic rule is used as a portfolio historically that's 40% bonds, 60% stocks, and then you have a justifiable income that you can take from that portfolio so you don't run out of money through good markets and bad markets of 4%. Just multiply the 4% by the value of your portfolio, and that's an income stream you can take out consistently without having more life than income. As well, the model assumes that you can adjust that income to the inflation rate every single year. So 4% multiplied by your portfolio value, indexed to inflation every year. If you don't go above that 4% rule, then the numbers say you're not going to run out of money. Now, this is based on historical trends in the markets, and there's no guarantee that those trends will continue in the future. So if you want to be doubly sure, then maybe you use 3% just to add a little bit of a buffer. Now, I'm going to go to the tools section of our website and just show you one of the tools you can use to do a basic calculation on how this rule of thumb could apply to your situation. Now, to get to the calculator, you just go to the Humphries Wealth Group website, humphrey'swealthgroup.com. Go to the bottom of the page. You'll see in the bottom menu bar there's going to be various options. But if you just click on Toolbox here, and then you'll see Online Financial Calculators, and you'll get to those calculators. So the calculator that would work best is How Long Will the Money Last calculator. And then I've got a couple of scenarios here for you. So if we have a $500,000 portfolio, in the first scenario we used a gross return of 5%. We assumed 3% inflation, so we're netting 2. That's a pretty conservative assumption for a balanced portfolio over the next 20 or 25 years. The other scenario is $500,000, 6% return, so 1% higher, and then a 3% inflation. So we're assuming a 3% net of inflation return instead of the 2% net of inflation. Using the 4% rule, we're taking out $20,000 per year from each portfolio. So again, if you look at that income, I go through the years. By the 34th year in this example, 33rd year, that income goes up to $51,502. So it's getting increased every year to cope with inflation. So what you'll see with this calculator is that in this first scenario, we're getting 2% net of inflation. The portfolio is going to last 34 years. If I'm 60 when I retire, then I'm into my early 90s, and not a bad outcome, but theoretically I might run out of money in that scenario. But if I have other assets, real estate, I might be fine. If I get a 6% return, 3% inflation, that portfolio is going to last me 43 years. So well past average life expectancy. I'm not likely to lose or run out of money in that particular scenario. Now, again, as I said, the caveat is, we don't know what the future is going to hold in terms of performance on portfolios. Now, we would be disappointed on a balanced portfolio of 40% bonds, 60% stocks to get returns net of inflation of about 2%. That would be disappointing. We would expect, and there's a probability of a better outcome than that. But at least this is a starting point. So again, when you look at your situation, take a look at your government benefits, employer-sponsored pension plans if you have them, and then if you want to be conservative and make sure you don't run out of money, the 4% rule is a good starting place in terms of your calculations. Okay, you've got a detailed budget. You know exactly what your needs are. You're reviewing that budget on a regular basis and course correcting if needed. You know your discretionary and non-discretionary expenses, so you can course correct along the way and reduce some of the discretionary spending if you need to. And then the 4% rule. Okay, so what are the next areas that we want to take a look at? Timeline investing, or sometimes referred to as a 3-bucket approach. It's a very simple approach. Divide your portfolio or investing timeline over the next minimum 10 years. And you'll see an image on your screen where basically you've got the first section, which is money that's needed over the next 1, 2, 3 years, let's say, for cash flow, liquidity expenses, maybe travel, things that are coming up. That money has to be in very guaranteed investments. The next timeline is for expenses or allocations that are going to come out in the next 4, 5, 6 years. So you have a call on that money. You're going to need it, but you've got a little more time to work with, and so you can put your money in investments that will give you a better return potentially than cash investments or GICs. The last section is growth investing. You don't need that money for 8, 9, 10 years. That's going to be the rocket fuel for your portfolio, where you want to take on more risk. Financial risk is not losing capital, but it's just having more money in the market in stocks or high-quality equity investments. That's going to drive up the performance in your overall portfolio. So apply those 3 buckets, and the way you can apply those buckets is really knowing what your cash flow needs are going to be and then allocate accordingly. So what you're trying to do here is buy yourself time with your portfolio. If markets are volatile, as long as you've got this timeline strategy in place, you don't have to worry or panic. You've got money that's very conservatively invested that's there specifically for those needs. You can keep spending at that rate because you're not selling anything off at a loss. Now, a companion strategy to the timeline investing is a cash wedge. Again, you've got an image in front of you on your screen, which basically is a circle. That's your overall portfolio. There's a little piece of that portfolio that is a wedge, and that should be in cash equivalent investments. Essentially, you'll identify how much am I taking out each year over the next 3 years, and I'll put in that wedge strategy either GICs, high yield savings accounts, T-bills, money that's very, very conservative, so you never have to sell money, assets at a loss to generate the cash flow that you need. So one of the issues for retirees is if they're cavalier, not reviewing their cash flows, taking money out of the portfolio, and then particularly taking money out during a down market. So you're taking the steady rate of income over time, but in a portfolio balance that's going down over time, that just puts a lot of pressure on the portfolio. So you need to adjust along the way if necessary. Now, the last strategy that we'll take a look at is computer modeling. By far and away, the most effective way to deal with these strategies is to build a financial model that takes into account portfolio returns, inflation, when the money is going to come out of your portfolio, the tax consequences. And that can only really be done through financial modeling. And that modeling can be very powerful as a way of giving you confidence and peace of mind that you're tracking in the right direction. So I'm going to give you a quick overview of an example of some financial modeling that we do. Let's take a look at that right now. Okay, so what you see in front of you is some data that we've entered for Sam and Sally Sample. So they're transitioning into retirement. And again, these numbers that we have on the screen, the important thing is not the numbers. It's the basic idea of what we do when you do these forecasts. So Sam and Sally retiring, the after-tax income they arrived at that they needed was $51,000 per year. Your number is going to be different. And that number was being inflation adjusted every year to inflation. If we go back to the scenario, the inflation rate that we used in this scenario was 3%. And we used a 5% return on their portfolio. So that cash flow was coming out every single year. By their age 75 as an example, it's now $67,000 per year after tax with the inflation adjustments. Now, in their scenario, what Sam and Sally decided is because they don't have any defined benefit pension plans, so their old age security and CPP, they didn't start taking those benefits until age 70. So you can see the benefits here kicking in for Sam. And if I go to Sally, again, in terms of her benefits, she decided to begin taking those benefits right away. So in one situation, we've got the benefits coming out right away to supplement cash flow, and then Sam's taking his benefits out at age 70. And he's doing it because he is concerned about longevity risk, and he wants to build up that government benefit package, and he knows it's fully indexed to inflation, so he decided to do that. That means that to generate the cash flow they need, they'll have to pull money out of their portfolio every year, and then less pressure will come on the portfolio when they get to age 70 for Sam. So the way that looks, let me just give you a chart here. We'll look at the combined chart for them. And so that combined chart allows us to really get a big picture of what it looks like. So the purple here is their inflation adjusted expenses. Again, by the time they get to age 90 here, they're up to $104,000 per year. The red here is the tax cost. And what you see here is that the brown represents actually surplus. They're actually reinvesting money back into their portfolio, it looks like. You look at their cash flows in the early years in the green, they're putting pressure on their registered accounts. They then have the government benefits coming in full on when Sam is age 70. If you look at their net worth statement, you can see here that their home, which is real assets, is never used to generate cash flow. Their registered accounts go down in value over time. TFSA account actually builds because they have some surpluses in their planning. Okay, so they look like they're on track. What this allows us to do, though, is to get very specific on what we need to do in terms of generating cash flow for them. So let me just show that to you. So we're going to take a look at the planning report. Let's just take a look at that. So in the planning report, this is their cash flows. This is a roll-up of their joint cash flow needs. And what you can see here is that we've identified in these bracketed items, they're pulling out about $40,000 per year on a pre-tax basis from the registered accounts each year. You can see that later on when Sam's full benefits come in for CPP and OES, that they go from being $44,000 per year down to $11,000-$12,000 per year. And in fact, they're adding some money to their TFSAs in this scenario. Now, is that the right scenario? Maybe not. What we can do is we can go back to the scenario for them and take a look at what is their sustainable spend. So they said, well, our goal is not necessarily to build up additional estate value and save more. We may want to spend more. So we do a sustainable spending calculation here, and then the program arrives at an adjusted expense number. So we go from 53 to 55 or 51 to 55. So they could afford to spend another $4,000 per year after tax over and above the budget number that they gave to us. Now, the one thing about these assumptions is they are assumptions, and the assumptions can change over time. And what I mean by that is there is a philosophy around some of this, right? So if I go back to the charts and I take a look at this expense number, generally speaking, the purple here that's going up every year, usually when people get into their 80s, they see a plateauing of expenses. So what does this analysis look like if we plateau expenses and we don't keep increasing them at 3%? Most people's expenses, particularly for discretionary spending, go down. That may mean they could spend more at the front end of their retirement. Some people may argue, no, I want you to keep the 3% in because my discretionary expenses may go down, but my non-discretionary healthcare expenses may go up. Okay, so it's a bit of a piece of clay. The assumptions do have a big impact on what the final numbers look like. The most important thing in terms of this particular discussion on the report is that the report allows us to identify from a cash wedge standpoint or a 3-bucket approach how much has to be in that very conservative part, because this plan tells us we're pulling out $40,000 a year. We better make sure that we've got conservatively invested that money in the portfolio. Well, it's my hope that that information proves helpful for you. Again, subconsciously people worry about running out of money, but you can reduce that anxiety if you implement these strategies, and probably most importantly, make sure you have a retirement planning specialist. Use a computer modeling to put together a customized model which really deals with and addresses these questions much more precisely than general rules of thumb. Again, there's a link back to our website if you want to explore that service and have a conversation. And there are links to other resources that can be helpful to you in your retirement income planning. If you haven't subscribed yet, make sure you do that so you don't miss future content that we're posting all the time. Anyway, I'm wishing you all the best in your retirement income planning as well as your wealth planning journey. You take care. Bye-bye.